What's up everybody, welcome back to my YouTube channel. I am Riza Ramzani, and this is Business Ideas. I'm sure most of the beginners have this kind of problem to pick a good stock. So I thought with myself, who is better than Mr. Warren Buffett, so I gather all advice he said for beginners to pick a stock. Before we start the video, make sure you hit the subscribe and like button. Okay, let's start the video. Here are some advice of Mr. Buffett for beginners. Warren Buffett's advice on picking stocks. Warren Buffett, the billionaire CEO of conglomerate Berkshire Hathaway, is one of the most successful stock pickers and value investors of all time. And many investors aspire to replicate his success. The good news is, you can learn the principles Buffett uses to choose stocks and apply them to your own investment strategy. Invest in what you know. Before you invest in any stock, you should be able to understand what the business does and how it makes money. That's the reason Buffett has historically avoided most tech stocks. He says he simply doesn't get their business models. So he sticks to what he knows best. While Berkshire's stock portfolio and subsidiaries represent a diverse mix of companies, you'll notice a high concentration in certain industries, such as insurance, banking, utilities, and consumer products. These are all businesses Buffett understands very well, so it makes sense that he's willing to put a great deal of capital into them. Learn the basics of value investing. Buffett believes that most Americans are better off buying low-cost index funds as opposed to individual stocks. It's not that there isn't money to be made in evaluating and selecting stocks, but most people don't have the time, desire, or knowledge to do it right. Buffett has said that what is smart at one price is stupid at another. With a strong knowledge of value investing concepts, you'll be well positioned to make that distinction. Identify cheap stocks. Once you've established your value investing criteria, it's time to make a list of stocks that fit your wish list. For example, let's say you want stocks that trade for less than 15 times earnings and have a strong history of generating 20% returns on assets year after year. Most brokerage accounts offer screeners and other tools to make this process easier and will generate a list of stocks based on your criteria. Find businesses that will stand the test of time. Once you have a list of stocks whose metrics look attractive, narrow it down by choosing businesses that will hold up well during recessions. This is why Buffett loves to invest in utilities. Eliminate businesses that are highly dependent on a strong economy, such as retailers that sell discretionary or luxury products. You also want to look for businesses that have a durable competitive advantage, or a wide moat. As Buffett says, there are several things that can give a business an advantage, such as efficiency, scale, or a proprietary technology. To give one example, Buffett's favorite Coca-Cola has an amazing distribution network, as well as an extremely valuable brand name that gives it pricing power. Invest in good management. It's hard to put enough emphasis on the value Buffett places on good management. Buffett will invest in a stock only if he trusts management and thinks it will continuously act in shareholders' best interest. Positive signs include a history of dividend growth and buybacks, and excellent reputations. Buffett often spends a considerable portion of his shareholder letter praising the leaders of Berkshire's subsidiaries, and he has bought and sold investments based on management actions. Be aggressive during tough times. It's generally a bad idea to time the market. Long-term investors will probably do fine no matter when they buy. Yet it's still important to look for opportunities during tough economic times. I often tell people that one of the secrets of successful long-term investors is that they love market corrections, as they offer the best opportunities. Buffett invests money in good times and bad, but he did a great job of capitalizing on opportunities during and shortly after the Great Recession, with such savvy deals as his Bank of America investment. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold, Buffett told shareholders in his latest annual letter. Keep a long-term mindset. In regard to Berkshire Hathaway's stock portfolio, Buffett has said that our favorite holding period is forever. However, that doesn't necessarily mean Berkshire will hold any of its stocks forever. In fact, Buffett and his team sell stocks regularly, and there are a variety of good reasons for selling your holdings. What Buffett is trying to say is that he goes into his investments with a long-term mentality. In other words, if he can't see himself owning the stock for years, he won't buy it at all. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, Buffett has said. Buying stocks because you think they're going to have a good quarter or because a hot new product is being released next year is simply not Buffett's way. How has the company performed? Companies that have been providing a positive and acceptable return on equity for many years are more desirable than companies that have only had a short period of solid returns. The longer the number of years of good ROE, the better. In order to accurately gauge historical performance, an investor should review at least 5 to 10 years of a company's ROE. Important, when looking at a company's historic return on equity, it's also essential to compare this with the ROE of the company's top competitors in the same industry. How much debt does the company have? Having a large ratio of debt to equity should raise a red flag because more of a company's earnings are going to go towards servicing debt, especially if growth is only coming from adding on more debt. Instead, Buffett prefers earnings growth to come from shareholders' equity. A company with positive shareholders' equity means the company generates enough cash flow to cover its liabilities and is not relying on debt to keep it afloat. For Buffett, low debt and strong shareholders' equity are two key components for successful stock picking. How are profit margins? Buffett looks for companies that have a good profit margin, especially if profit margins are growing. As is the case with ROE, he examines the profit margin over several years to discount short-term trends. To stay on Buffett's radar, a company's management should be adept at growing their profit margins year over year, a sign that management is also good at controlling operating costs. How unique are the company's products? Buffett considers companies that produce products that can easily be substituted to be riskier than companies that provide more unique offerings. For example, an oil company's product, oil, is not all that unique because clients can buy oil from any number of other competitors. However, if the company has access to a more desirable grade of oil, one that can be refined easily, then that might be an investment worth looking at. In this case, the company's desirable grade of oil could be a competitive advantage that helps it earn profits through greater sales and margins. How much of a discount are shares trading at? This is the crux of value investing, finding companies that have good fundamentals but are trading below where they should be. The greater the discount, the more room for profitability. The goal for value investors like Buffett is to discover companies that are undervalued compared to their intrinsic value. An opportunity to buy at a discount exists when a company's current market value is cheaper than its intrinsic value. While there is no exact formula for calculating intrinsic value, investors will look at a variety of factors, such as corporate governance and future earnings potential, to estimate intrinsic value. The bottom line: beyond his value-oriented style, Buffett is also known as a buy-and-hold investor. He is not interested in selling stock in the near term to realize capital gains. Rather, he chooses stocks that he believes offer good prospects for long-term growth. This leads him to move focus away from what others are doing. Instead, he looks at whether a company is in a solid position to make money moving forward and if its stock is sensibly priced. Well, this is for today's video. Hope it would help you to know where to start investing in stock market. If you like it, share this video with your friends so they could see this video too. Well, thanks for watching this video. I will post new video every week. Until next time, be nice to each other.